Nice to have you with us this morning. Executives from Canada's largest grocery players are set to meet with the federal industry minister in Ottawa today. You might have heard the Prime Minister, Justin Trudeau, has called for companies to come up with a plan to stabilize food prices at stores, with a warning that there could be some tax penalties if an effective plan is not presented. I want to bring in Courtney Heels from the CP24 team, who's been talking to grocery store consumers in the Toronto area this morning. Courtney, good morning. Give us a sense on what people are saying.
Good morning, John. This is welcome news for a lot of people who are heading into the grocery store behind me to pick up a few things. Many of them are telling me the same thing. They say it's really hard to budget. You go into the store, you have a list, and it just gets very expensive. So they say they'd like to see what actually will come out of this meeting. And many food industry experts are saying the same thing. This sounds good, but will it actually result in some savings for people at the cash register? You mentioned the hope here is that the heads of these 5 major grocery stores, so we're talking about Loblaws and Metro, for example, coming together to come up with this plan to help stabilize prices, but it's still not clear if it will actually result in any savings down the line. And many are also saying it's not just as simple as, oh, the grocery store needs to make a change. Some are suggesting that others need to be involved in the conversations that will be happening in Ottawa. For example, anyone involved in the distribution chain.
I think what's so interesting, Courtney, is this is happening at a time when a lot of people are trying to figure out who is responsible for helping get the economy to where it maybe needs to be in this fight against inflation. You know, we cover the Bank of Canada and central banks raising interest rates. Here you've got the federal government with this conversation with the grocery executives. But I heard you on our sister channel, CP24, this morning, also talking about those, including on the conservative side, who just see this as a little bit of political theater that won't necessarily result in benefits for Canadians.
Yeah, I mean, as you mentioned, opposition leader Pierre Poilievre saying this is essentially political theater. It won't result in anything other than a photo op. And we've heard from other experts in the food chain who follow this topic very closely saying it might just be politics at play. Will it actually result in any changes? And we know, talking to people who are shopping, they say they don't want to hear about all the meetings and the details. They just want to know, will it mean that when you go to the store, for example, to pick up a carton of eggs, it's not going to cost, between $5 and maybe $12, and not really having that certainty. I even talked to a business owner this morning, John, who told me it's especially frustrating for him because, he has a list. He has an idea of what he needs to pick up at the beginning of the week on Monday morning, and it's really hard to budget. And we know this is something that's so important for Canadians. And this is why, affordability, the cost of food, it's going to be top of mind for everybody, especially politicians, as they return to Parliament Hill this morning.
Courtney, thanks very much for the report. We appreciate it. Courtney Heels covering the grocery story for our CP24 colleagues.
The 24th World Petroleum Congress continues today in Calgary. Let's get more on the workforce needed for this much vaunted energy transition. Also, our guest, who represents energy service companies and suppliers, has overseen a name change of his organization. Our Tara Weber is there now with the president and CEO of Enserva. Go ahead, Tara, please.
Thanks so much, Andrew. That's right. I'm here with Gurpreet Lal, and you're the perfect person to talk to when we think about this transition that's underway and the workforce that's going to be needed. What do you think we still really need and what we're missing in terms of that big piece?
Oh my gosh, we still need people. Everybody's talking about this transition and where we're at with the workforce, and we've been saying this for now almost 2 years, that we have a huge shortage of labor in our current state of industry, let alone what we're going to need for growth. We talk about going to net zero, and from the calculations that we've done and the economic analysis, you're going to need at least $1.3 trillion thereabout to get to net zero. And in order for that to even happen, we need people and we need capital investment. And people we don't have right now.
This is a conversation we've been talking about for a couple of years now, that we don't have enough workers left in the energy sector. A lot of the older people have left that would be training the new people coming in. How big of a problem is this right now?
Right now, I would say it's a big problem, especially where we're headed into the future. Like we need more young people coming into this industry and not shying away from this industry. There's this rhetoric out there that oil and gas is a dying industry, and it's not. You're going to need oil and gas in the new energy mix for decades to come. It's not going away anywhere anytime soon, and it'll always be part of the energy mix. So, I would say we need new young graduates, we need skilled labor, we need green labor, and we're trying different tactics to bring people into the industry right now.
Now, we did talk to the federal labor minister yesterday, and he was pointing to some of the retraining that the federal government is doing. What more could they be doing, and what are they missing?
You know what, I would actually ask them, what retraining are you doing currently? Because you don't need to retrain people that are in the sector right now. The drillers that are working on drilling rigs and drilling sites today are going to be needed to be working on geothermal sites tomorrow and today to get us to this new future of an energy mix. So I would actually ask, what are we retraining people for? What we do need to be focused on is bringing more people into this sector. And that includes, different ethnicity groups coming in that we traditionally don't attract into the sector. Women, Indigenous groups. We should be doing more about that and getting more education and training into high schools. Where are the shop classes that used to exist back in the day? They don't exist anymore. We still need welders, we still need pipe fitters, we're still going to need that labor that they don't need to be trained into something else. They need to be trained to do the jobs of today to take us into tomorrow.
One of the things the federal government has consistently said is that they are trying to retrain, especially when it comes to Indigenous groups and First Nations communities. Isn't that what they are doing?
Retraining?
Well, training in general, getting those groups into the industry.
Say fantastic. Where? Because we're not seeing the result of that training coming into industry today. When we look at training different populations and groups, we're finding that our members are doing it on their own. And from our membership as Inserva, what we decided to tackle is we can't wait for governments to solve this problem. So we decided to come up with a solution on our own to say, we're going to launch a portal, and it's called the Working Energy Portal, that matches prospective employees with employers and their skill set. So if you think about Uber or different matching tools that are out there, we're going to have people come and register on the app with whatever skill sets they have, whether they're green, brand new to the industry, or they have some level of skill sets, or they've got university degrees, or what's required for the job. Match them up with employers and let the employer take it from there. We've done a lot of talks with women groups that are focused solely on women, bringing them into the sector. I've done a number of talks to different immigrant groups to just say there are careers to be had in the energy sector that a lot of people don't understand. A product of immigrant parents, we were taught you're going to become a lawyer, engineer, doctor, maybe an accountant, and there's nothing in between. And now having those conversations, you come into the energy service, supply, manufacturing sector, you can work as a green hand and work your way up, and you can run the company in a decade. What other industry is going to provide that for you?
Fair enough. Okay, and just quickly, I have to change the topic a little bit. Inserva, more commonly known as PSAC, Petroleum Services Association of Canada. We're also seeing the World Petroleum Congress changing their name. Does it help to take oil and petroleum out of your name?
So twofold. Does it help? It does and it doesn't. We've had a lot of people saying, why are you changing your name? Period. Be proud of having petroleum, and we are. But our members were also diversifying, and they were evolving, and they needed to see the mix in our association. And when you look at some renewable companies out there, they didn't see themselves when you're just saying petroleum services, right? So we said, and I didn't want to just take away the P and put in an E and still be something SAC. So we were like, oh, we're energy services, that's who we serve, and we'll come up with a new name so an acronym cannot be given to us. But we are representing a whole entire sector and not just subsects of energy.
Perfect. Thank you so much for your time today.
Thank you so much.
That was Gurpreet Lal, president of Inserva.
Shopify shares have been under pressure 4 sessions in a row now, slumping to a near 1-month low. But our next guest is among one of the most bullish analysts on the street, seeing some major upside, price target of $80 US per share. Ken Wong is the managing director of software research at Oppenheimer and joins us now. Ken, thank you so much for being with us. First, let's kind of explain the pullback. Is it Shopify specific, or is it just kind of getting caught up in a downdraft?
Yeah, great. Thanks for having me. I think you've got a little bit of both there. We definitely have seen a bit of a pullback on a lot of our software names. So naturally, Shopify will see the same kind of downtick along with the group. Specific to Shopify, I think as many investors, many viewers have noticed, at the end of August, they signed a partnership with Amazon. We saw a big spike up in shares, on that particular piece of news. I think since then, there's probably been a slightly more sobering effect as investors try to feather in kind of what they think the potential monetization benefits are. And like a lot of long-term partnerships, I think these things will take time, takes a little bit to scale up, get merchants to adopt the capabilities. So I think the realization was just that the immediate potential revenue uplift was further out than a lot anticipated. And that's probably partially also driven some of the shares lower.
How are you thinking about the Amazon relationship? Do you feel like you've got a better handle on it than perhaps what the market is struggling with?
Well, look, my general view of a lot of these partnerships is that it adds to the value of the platform. I see it less as an immediate pop from a top line or from an earnings perspective. I think it does de-risk the possibility that Amazon comes in and just tries to siphon away a lot of these merchants. The previous go-to-market for this Buy with Prime implementation was that a merchant would have to go rogue and essentially add the script to their site separate from Shopify. Now Shopify is an actual participant and actually gets to maintain the unit economics that they had previously. So, I think it's less of an additive dynamic to top line, but definitely does put a large competitor at bay. And again, it does feel like they had a little more leverage in those negotiations than a lot of investors anticipated. So yeah, my view is just that every incremental channel that does support the Shopify platform, largely just reinforces the value that a merchant will get from putting their storefront on Shopify.
Chief complaint often on Shopify is about growth slowing and the valuation still very demanding.
Valuation is always going to come up with a lot of these high growth, potentially kind of market changing type companies. Our view here is right now we're in a bit of a middle ground. They recently divested their fulfillment business. That was arguably one of their larger TAMs. And so investors are trying to figure out, is Shopify still a 20% plus hypergrowth company? Are they potentially going to pivot to more of a margin expansion story? Like, we're definitely getting margin expansion through next year, but I think investors are still looking for management to convey exactly what Shopify is going forward. We're optimistic that they potentially could host an investor day before the end of the year. Hopefully, should they have one of those kind of events, that we'll get better clarity on what the vision management has for the company. And at that point, I think investors will be able to properly calibrate in their valuation framework kind of what's the right multiple to apply for this company.
You see the stock, even with complaints about current valuation, going even higher, implying more than 35% upside from here. What gets you there?
Yeah, we definitely think that our $80 price target is achievable in the next 12 months. We think of Shopify as a high teens, potentially 20% CAGR growth type of a company. We expect to see meaningful margin expansion over the coming years. And typically, those are the kind of companies that investors are willing to put a premium multiple on. In our DCF-based valuation, we do have the terminal margin of this business being closer to mid-20s. And usually that ascribes a mid to high 20s terminal multiple, which I think when we discount that back, that helps us arrive at our $80 price target.
All right, Ken, we got to leave it there. Thanks so much for that perspective. That's Ken Wong joining us from Oppenheimer.
Well, Ontario Premier Doug Ford says he is reversing his plan to open the Greenbelt lands for housing development and is putting the lands back under Greenbelt protections. Ford also says he won't make any changes to the Greenbelt in the future. Last month, reports from the Auditor General and Integrity Commissioner found that the process to select lands was rushed and favored certain developers. Since the report, Ontario's housing minister, as well as the Minister of Public and Business Service, have resigned. Speaking at a press conference, Ford says ultimately he made the wrong decision.
It was a mistake to open the Greenbelt. It was a mistake to establish a process that moved too fast. This process, it left too much room for some people to benefit over others. It caused people to question our motives.
Well, turning now to some federal politics, the quickly worsening diplomatic standoff between Canada and India also threatens economic ties. Canadian portfolio investors have a large presence in India. Canada is the fourth largest source of tourists to India, while India is by far the largest source country for international students to Canada. For more perspective, joining us now is Jeff Nankerville, President and CEO of the Asia Pacific Foundation of Canada. Jeff, thanks so much for joining us today.
Hi, Jacqueline. Thanks for having me.
So it seems like this situation, the tensions that have arisen since Canada made these allegations, since the Prime Minister made these allegations against India, that state agents were involved allegedly in the killing of a Canadian citizen on Canadian soil. The conflict has worsened quite rapidly. And I wonder if you could just give us a sense of just how fragile the relationship was leading up to this.
Well, the relationship had been, is one that has had its troubles over the years, going back to the 70s when India developed nuclear weapons after acquiring CANDU nuclear power technology from Canada. And we had the Air India bombing for a flight that originated out of Vancouver in 1985. In recent years, the activities of the Sikh, these pro-Khalistan Sikh activists in Canada, Sikh activists who are seeking a national homeland in India for the Sikh people, it's been a major irritant in the relationship. And the Indian government has been consistently sharply critical of the government of Canada for, in its view, not controlling the situation. But as of a few months ago, the relationship seemed to be on a sharp upward trajectory, and the countries were working together on an early progress trade agreement, a partial free trade agreement, and there was every signal that is something that might have been announced when Prime Minister Trudeau came to Delhi last week for the G20. But of course, we're in a very different place now.
Yeah, no doubt. And Canada, it has identified India as a priority in its Indo-Pacific strategy. And I just wonder, the trade talks, but also that strategy, where does this end up leaving things?
Well, I think an important theme of the government of Canada's Indo-Pacific strategy was diversification, and India was pitched as a very important element of that, and there was a very upbeat assessment of the potential of India in that, and that's no surprise. India is the fastest growing large economy in the world, and it has enviable demographics, especially compared to some countries such as China. So it was an important element, but the diversification theme in that strategy also put a strong focus on the countries of Southeast Asia as promising markets for Canadians. And certainly here at the Asia Pacific Foundation of Canada, we're talking every day with Canadian businesses, universities, institutions who are engaged in Asia. And there was already a strong enthusiasm for doing more in Southeast Asia. And I think one result of this week's developments is you'll see that focus on Southeast Asia becoming even sharper.
Could this have an impact on the trade that is already happening between these two countries?
There is the possibility. The measures we've seen taken so far by India are measures where there's a logical link to the situation. The Indian government claiming that that there is a safety and security problem for Indian diplomats and others from India in Canada. So the closure of the visa offices was a very significant step that's taken today. I would just note in the short term, this means Canadian business travelers, and not just those applying from Canada, but reportedly Canadian business travelers applying from anywhere in the world for a visa to India will not be able to come to India. And of course, that places them at a competitive disadvantage. But the other, the major economic ties in the relationship, the single greatest economic relationship is around the student flows to Canada. And if the media environment in India, which we're monitoring here very closely, our research team is looking at domestic language media in India. It's a feverish environment, a very sensational coverage of the situation between Canada and India. And the Indian government has issued a travel advisory to its visitors to Canada, and specifically to students, advising them that their safety could be at risk. So it remains to be seen if that will influence the decisions of prospective students coming from India. But I would say the demand in India for education in Canada has been very high. It's grown steadily over the last few years. I think it would take a lot to knock it off course, but if it were to diminish, that has implications for not just for colleges and universities and private professional schools, but also for communities across the country that are host to these Indian international students.
What about the pension funds with investment in India, exposure there? Do you see any sort of fallout that could affect those investments or perhaps future investments?
Well, it's not. I wouldn't say there are immediate indications of that. The major Canadian players, Canada Pension Plan, the CDPQ in Quebec, and others are, including Brookfield Asset Management. They are, well entrenched in India, and they are investors of choice as partners in India, and they have strong partnerships. So I think they have robust relationships that will stand them in good stead in the short to medium term. So there's no I don't see any immediate indications that their position could be at risk. Although of course it's an inconvenience that their own people will not be able in the short term to travel from Canada to India in connection with deals. But I think we already know how to work around those kinds of things from the experience of COVID.
Well, yeah, that's a great point. Virtual meetings and whatnot can go a long way. Jeff, thanks so much for the context on this. We really appreciate it.
Thanks for having me.
That was Jeff Nankervis, President and CEO of the Asia Pacific Foundation of Canada.
Our featured guest this morning is a portfolio manager. She's Lanka Martin, managing partner at Sustainable Market Strategies and Nordis Capital. Thank you for joining us. Great to have you.
Hi.
It's your first time in the studio. Great.
It is, yeah.
Wonderful to have you here. Let's talk about your views of these markets. I think you think the Fed has got it right here. Its view on inflation is correct, you believe?
Yeah, so when we looked at I'm sure you've talked all week so far about what the Fed and other central banks have been doing this week. But for us, I think the thing that was I was paying attention particularly was how the sort of dot plots or the FOMC projections changed this time or not. Mm-hmm. And in the case of what we really look at is the inflation element, because this is the thing that, of course, has pushed rates as high as they have so far. What we find interesting is that the 2023-2024 predictions by the Fed for core inflation mm-hmm. are still quite a bit above 2%. So
stretching out how far?
Well, I think it only comes back to the to under 2% for core, maybe 2025, 2026. I'm not mm-hmm. quite sure. I personally don't look too far out past the 2-year mark. Mm-hmm. But basically, I think that what it's telling you is that if you're just looking at core, it's unlikely that the Fed themselves, think that they're going to stop. I think we're going to talk about food and maybe even oil a little bit later mm-hmm. in the show. Mm-hmm. But if we look at the sort of the bigger picture in inflation, there's lots of reasons I think to think that we need to be a little bit more cautious on when we talk about inflation coming down mm-hmm. too rapidly in the U.S.
Higher for longer is the message that the stock market investors have to absorb. Yeah. It's a difficult lesson. They seem not to want to absorb that lesson at times.
Yeah, and what I would add to that is that, when we saw a bit of a rates back up last year around this time, we have to remember that the consumer was in a fairly different position in the U.S. So balance sheets were quite a bit stronger. So when we're going into this mini rate hike cycle or mini sort of trend in yields that we're seeing, we're starting from a consumer that's probably not quite as healthy as we saw when they took it last year at this time.
And so you are avoiding or underweighting consumer discretionary stocks,
Yeah,
correct?
so basically we're, as you know, we do sustainability investing. We're really focusing on sustainability themes. And one area for us that we tend to look at from an underweight position is always the consumer discretionaries, because there's a lot of businesses out there that we just don't find that are sustainable. So we're looking for opportunities to be short or underweight the consumer discretionary sector. Obviously, very interest rate sensitive area. So the macro and the sustainability are lining up for us, we think.
You do take short positions on occasion, and you're willing to go short on consumer discrewashiries right now.
Exactly. For example, we have a current short on LVMH, so in the luxury sector, for example, because we think that that's really a company that's doing quite a bit of greenwashing or potential for greenwashing. So that's an area where we're seeing that the consumer budgets are really not holding up, and we think that the macro is lined up, as I mentioned, with the environmental sustainability.
And where do you see pressure on consumer budgets coming from higher interest payment obligations on mortgages? That's a big theme, particularly here in Canada, where the point is made that we have 5-year mortgage renewals.
Sure. So you're absolutely right that the transmission mechanism of monetary policy in Canada is a little bit different than our focus, which is on the U.S., obviously, where rates tend to be more of the fixed nature. So that mechanism, is felt much quicker in Canada, I think, from a rate perspective than in the U.S. And so clearly, when you see the headlines in Canada, they always come earlier in the rate cycle when it comes to housing, particularly relative to other economies they're more tied to the consumer is more tied to the long end.
That's Lanka Martin. She's our featured guest of the morning.